Hello again, this is the final part of Elliott Waves Theory dedicated to binary options, and this is important to remember that we covered here only what's necessary to trade and elementary to trade binary options with when you use Elliott Waves Theory. In reality, the concepts are far more complicated, and there's a lot of knowledge behind counting the waves. First of all, the approach to Elliott Waves is very different. You must start from the bigger time frames in a so-called top-down analysis. You start from the monthly chart, and therefore you interpret a cycle of the biggest cycle, and then you continue on the weekly chart from where you left on the monthly chart. You continue on the daily chart from where you left on the weekly, and 4 hours, and so on and so forth. And therefore you'll end up having the entire picture of the entire market laying in front of your eyes. So you may be wrong on the lower time frame depending on what the market does, what the algorithms do, what the high frequency trading levels the market will reach. But on the bigger picture, you know where the market goes. And the biggest advantage when you trade with binary options is that you can put the time working on your side. Namely, choosing the right expiration date. It may be that you are wrong with a count and so on, but the market still may have time to go into your direction. Anyways, we've covered here the basics of the Elliott wave so far, the rules of an impulsive wave, the rules of corrective waves as a three-way structure. We didn't cover all the types of corrective waves, all the types of an impulsive wave. We covered only what's enough to know that, only what's enough to trade binary options with. For a corrective wave, you may have a triangle. Actually, triangles forms most of the time. But maybe we'll have other analysis discussing various setups with Elliott Waves' wonderful trading theory. Let's pick a currency pair and whatever. Let's go here with what? I don't know. US dollar and Canadian, US dollar, Swiss franc. Excellent. US dollar and Swiss franc. Actually, we can't do this here. We must open a new chart because otherwise we'll remain with the screen being US dollar, Swiss franc. Excellent. So let's go with a different time frame. Let's go with the hourly chart or with the 4-hour chart. In this way, we should interpret differently the expiration date that we have on the 4-hour chart. On the 4-hour chart. All right. Now, let's look at the market on the recent move that we see on the US dollar Swiss franc from here to the bottom. The very first question you must ask when you look at the move from the top to the bottom, let's go from this one, from here to here, is this an impulsive wave or a corrective wave? Definitely you cannot put this one as an impulsive wave. Remember, you need to have an extended wave, a wave that is bigger than 161.8 when compared with the next longest one. So how do you do that? Well, simply go and take a Fibonacci expansion this time, and you start from the beginning of the move and you say 1, and what will be? This will be the second wave, right? 2. Look where 161.8 comes. So there's no impulsive wave here. Plus, the third wave here needs to be an impulsive wave. The first wave here needs to be this is no 5-way structure. If a move is not impulsive, it has only one possibility. It's a corrective wave. If it's a corrective wave, we can deploy what we already know from a corrective wave. We use this horizontal and vertical lines to know that we address only the price action on the right side of this line. We don't care what's on the left side. This helps you very well when you do top-down, when you make top-down analysis with the Elliott Waves Theory. Now, if this is not an impulsive wave, it must be a corrective wave. Remember, a corrective wave is labeled A, B, C of different degrees. We don't know the degrees, but we simply take and say, alright, let's say that this is a wave A. A wave A. Now this wave A, as we explained earlier on the Australian dollar and US dollar, this wave A, let's put this one back, the Australian dollar, US dollar, so that we'll have it with us Australian dollar, US dollar, alright, like this. So this wave A here might be either impulsive or corrective. Now look at it. Okay? Is this an impulsive or a corrective wave? It's no impulsive wave. Again, you have no extension. So it must be corrective. If it must be corrective, the price action must retrace more than 61.8. So when the market or when price comes here, how do we know where to buy a binary options? Well, first of all, you see at any trend, whatever its substance, if you want, makes a series of, in this case, if it's a bearish trend, makes a series of lower highs. So lower high, lower high, lower high. You simply wait for the series of lower high to be broken. This is where the series of lower highs gets broken. So market goes, pulls back. This is where we buy call options. Remember, we don't know this price action here. We are here. We buy call options for what? For the market to go to 61.8. It's the 4 hours chart. So we don't trade with an hourly expiration date or with 5 minutes or with 60 seconds. We trade with end of the day, with end of the week, even with end of the month if it is in the second half of the month. And then we go with what? We go and simply take a Fibonacci retracement. Let me see what it is, a Fibonacci retracement. And we measure the length of the move from the start until the end here. And we search for 61.8. We drag a line. The market must go to 61.8, or the golden ratio in Fibonacci. As long as it still tries for the 61.8, we do nothing but buy call option. See, here it missed. We buy call option. Probably here is another trading week and so on. The moment that the 61.8 comes, we simply take this letter here, we put it in here. So we have an A and a B, an A and a B. Again, how did we reach this conclusion? This is not an impulsive wave, it's a corrective wave. And if it is a corrective wave, the B wave must retrace beyond 61.8. If this would have been a 5-wave structure or an impulsive wave, the B wave should, or the B wave was not possible to retrace more than 61.8. So the more it would have advanced, the more we would have buy put options at that moment. But then that the 61.8 came, we want to trade some put options. But how to trade put options? How do we know that the C wave started? Well, that's very easy to put it this way. How come? The same theories, the same principle. In this case, we had what? We had a series of a high and then a lower high and then a lower high and then a lower high. In this case here, we had a series of a bullish trend. We have a low and then a higher low, higher low, higher low, higher. We wait for it to get broken. When it is broken? It is broken, or it gets broken when the market does this move here. When it does this move, we simply go and trade the put option. I mean, just like that. Why not here? Because the 61.8 retracement is the minimum distance for the B wave to retrace. It may go even 100%. It may go 161.8. We want to see the trend here broken. The trend gets broken, and then we go and trade the put option. With what expiration date? I don't know. Something like, again, end of day, not end of day, end of the week, end of the month, 2 weeks. If we measure this one with a shape to find out how many candles we have 43, 44 4 hours candles. So it's plenty of time for the option to expire, not to mention the move that come, because even if your option expires here, it's still an option, a good option to trade. So we have an ABC. We have an ABC, a first corrective wave. But as you can see, the market makes then and forms some kind of a move here. But then instead of following with another 5-wave structure, it collapses. What's this? The market tells us, the price action tells us, that this move from here to here, while it is a corrective wave, remember, between corrective waves, we said that the market forms a simple correction or a complex correction. This one here is a complex correction. Any complex correction has at least one X wave, and this X wave is always a corrective wave. It is called an intervening X wave or a connecting X wave. It connects two simple corrections, but more on this probably on some other occasions. The aim of these 5 waves, 5 parts of this Elliott Waves theory was to introduce to you to this wonderful theory. It has various concepts. To give you an example, only flats, there are 10 types of flats with 10 different rules to follow. On zigzags you have 3 types of zigzag, 3 types of impulsive waves and so on. But for the binary options trading, if you follow this simple logical process, because the whole theory is a logical process of steps put together. What if this is like this? If it's not like this, it must retrace, it doesn't retrace, and so on. And because we can shift the expiration date based on the time frame, binary options becomes profitable. Thank you for being here and have a great day. Bye bye.